Remember when Jay Pestrichelli from YieldMax said,
Look at total returns. That should be your judgment if this is a good or a bad investment or if it's meeting your investment goals. The way those returns can come, whether it's appreciation or distribution, it shouldn't matter. It should be the total return package.
that was probably one of the most valuable things he's ever shared with income investors. Because a lot of people still misunderstand what distribution yield actually means. When you see a fund paying you 50% or 70% a year, it looks incredible, but that yield is simply what the fund is paying out from the value it already has. It doesn't automatically mean the fund is creating that value. The real story is told through total return. That's the number that shows whether your investment is truly growing or if it's just returning your own capital back to you dressed up as income. So, keeping that in mind, let's run a quick 1-month comparison between WPAY and ULTY from September 5th to October 10th, 2025, and find out which fund actually rewarded investors the most. Let's start with ULTY. The price went from $5.49 to $5.55, and the fund paid out about 45 cents in distributions. When we add that together, the total return for the month comes to roughly 9.45%. So in 1 month, your investment grew by almost 10% when you include everything. Now, WPAY. Its price moved from $51.10 to $56, and distributions were $2.67. That brings the total return to about 14.8% for the month, significantly higher than ULTY. Looking purely at total returns, including distributions, WPAY clearly delivered more value to investors this month. Both are income ETFs, but for someone tracking overall growth of their investment, WPAY's combination of price appreciation and distributions made a bigger impact on your portfolio. Now, some people might point to the 1.2 times leverage that WPAY uses and say, well, of course it's higher. It's leveraged. But here's where it gets interesting. If leverage alone were the reason, we'd expect WPAY to be about 1.2 times the return of ULTY. 1.2 times ULTY's 9.45% return equals about 11.3%. But WPAY came in at 14.8%, well above that. So this outperformance isn't just a leverage story. It's a combination of stronger underlying performance, better price appreciation, and potentially a better portfolio of companies. The takeaway here is simple. When you look at total return, WPAY delivered more than just a boosted yield. It showed genuine growth in fund value plus income, and that's what ultimately compounds over time. Many argue that in a prolonged bear market, WPAY would get crushed, making ULTY the safer choice. But I don't see it that way. Let's play out a scenario that every investor eventually faces, a bear market. Not a small dip, not a red week. I'm talking about a sustained, grinding 20% decline in the market, the kind that tests how well a fund can really protect your capital. First, let's start with WPAY. It's a diversified portfolio of single stock income ETFs that all use about 1.2 times leveraged exposure to their underlying stocks, and that leverage resets every week, not daily. That weekly reset part is key. It means WPAY doesn't just keep compounding leverage losses indefinitely like a 3 times ETF would, but it still amplifies every move in the market, both up and down. Let's look at ULTY. This fund plays a completely different game. It's an actively managed covered call ETF, selling calls on high beta stocks and collecting those premiums as income. That approach works really well in flat or slightly down markets because those premiums help cushion losses. In a 20% market correction, ULTY probably wouldn't fall the full 20%. It might only drop around 15% thanks to those option premiums. But there's a trade-off. When the market rebounds, ULTY's upside is limited. Its strategy focuses on high volatility stocks, which swing fast in both directions, and it prioritizes collecting premiums over capturing every rally. So instead of a full 5% gain, it might only capture 2 or 3%. The key point that a lot of people are missing is this. WPAY thrives in bull markets, while ULTY tends to perform better in bear markets. If you look at market data from 1949 all the way to June 2025, bull markets have dominated. On average, they've lasted about 5.3 years, delivering a 254% return to investors during that time. Bear markets, on the other hand, have been much shorter, roughly 1 year on average, with losses around 31%. So Yes, if you happen to invest right before a downturn, that's tough. But if you stay consistent, keep investing through those bad years, history shows you almost always come out ahead. That's why a fund like WPAY, which benefits most when markets rise, is structurally positioned to outperform over the long term. Because if history repeats, and it usually does, the market spends way more time growing than shrinking. So, what's the takeaway? In a sustained bear market, both funds lose value, there's no avoiding that. But how they lose and recover is completely different. WPAY drops faster on the way down, but also recovers faster when the market stabilizes. It's built for people who believe in short-term volatility but long-term growth. ULTY, on the other hand, cushions the fall better, but sacrifices almost all of the upside when things start improving. In other words, WPAY gives you a faster ride, both down and back up. ULTY gives you a slower, smoother ride, but once you fall behind, you stay behind. That's why I believe that over the long term, WPAY is likely to outperform ULTY. So, to wrap this up, WPAY and ULTY are both weekly income ETFs, but they play very different roles in your portfolio. WPAY leans into growth with leveraged exposure, allowing it to recover faster after drops and capture more upside in bull markets. ULTY focuses on downside cushioning, which makes it steadier in declines but slower to recover. At the end of the day, it comes down to your goals and risk tolerance. But if you want faster total return growth and don't mind volatility, WPAY has the edge. I hope this breakdown helps you see how these funds behave in different market conditions and why total return is key when evaluating income ETFs. If you found any value in this breakdown, hit that like button, subscribe for more deep dives like this, and drop a comment with your thoughts or questions.